Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in February 2021. Bond markets were on the back foot in February in a material way as a liquidation of positions across global markets really challenges central banks in a way that's quite unique and something that we haven't really seen since the GFC. Clearly, the optimism of Biden's huge fiscal stimulus program combined with inflation expectation, which we know mechanically will rise into around the middle of the year, has markets on the back foot. But the sell-off has become self-fulfilling and there has been a wholesale liquidation late in the month, challenging central banks who've told us that rates will remain very low and they will use active QE programs to achieve their outcomes. This has huge implications for asset markets the world over. Clearly, we've seen these episodes previously. When interest rates rise quickly, that volatility does spread to other asset classes. Remembering that interest rates are the rubber band that affect all things, they are our funding rates, they are our discount rates. Clearly for markets like the NASDAQ and the technology heavy, they have huge implications in terms of what forward-looking earnings multiples might look like under differing scenarios. I want to just take you back to a period of the fourth quarter of 2018, where we had a similar bond market sell-off, but it didn't take long until it spread into corporate credit. Now remembering corporate credit is more expensive today than it was prior to COVID, which we think is nuts. Clearly there's a lot of government sustenance that's helping for those yield chasers to find those assets, but clearly as the risk-free rate rises, that can come under material sufferance, and it doesn't happen nicely and slowly in a straight line. We know when those markets give up the ghost, they are incredibly chaotic, as we saw last March and April. But going back to 2018, we had that period where bonds sold off incredibly aggressively when the Federal Reserve said to the markets that they were a long way from neutral, meaning the neutral interest rate, and likely to exceed it. The bond market hit the skids in a material way. Credit collapsed later on in that year, and there was no debt capital markets issuance of high yield bonds for about 6 weeks. And then equities nosedived about 20% into year end. That forced the Fed's hand in a reactionary way, and Powell came out in the early parts of 2019 and said he would be patient, i.e. there'll be no more rate hikes, and he was cutting rates shortly thereafter. So it's very much worthwhile thinking through what does this bond market move actually mean for the totality of portfolios. Certainly the move has been pretty pronounced. It's been huge in terms of the way that it marked into month end. Aussie interest rates have actually bounced back about 30% of that in the following session. So there is volatility, and that volatility will not stay in the risk-free complex for very long. What the sell-off has brought, though, is it has brought incredibly steep term structure curves. That is an incredibly powerful concept for forward bond performance. And we'll show you some charts of carry and roll and the performance of bond markets off steep curves with higher yields. The amazing thing about this, if you ask anybody what made bond markets do very well over the last decade, they will almost certainly say duration, and that is not correct. It's mainly carry and roll. And so the re-establishment of that really steep curve plus higher starting yields really rebuilds the defensive characteristics tremendously in fixed income, particularly in sovereign in fixed income, which remains liquid in times of stress. That's a really important fact. We've been speaking to a lot of clients, many of whom, by their own admission, have been underweight defensive assets and are looking at this sell-off as a great opportunity to re-enter and build up defensive characteristics. But one told me yesterday, because of the liquidity we had in sovereign bonds in March and April of last year, I could buy deeply discounted equities very easily, and I made 4 years of returns as a result of that portfolio optionality. It's something that you don't see in other assets that freeze up when they get to these risk moments where it becomes chaotic. So I really think that investors need to think that through, because if bonds continue to sell off into these higher inflation expectations, we don't think they'll move nearly as quickly now, but certainly momentum has been poor. And if Biden comes through with this huge overstimulus, then potentially that US Treasury market will lead that sell-off again, making room for that additional supply. It will have impacts on other asset classes. You're already starting to see that in equity markets at the end of February that are getting the jitters on the fact that rates are rising and they're rising too fast. The chasing of yield across the complex is something that's been an investor problem in response to very low risk-free rates. And that makes sense. People need income. But as these risk-free rates are rising quite materially and the steepness of these bond curves is coming back, those yield enhancements in lower quality credit can come under intense sufferance. And we know from previous episodes that that doesn't happen in a rational manner. It tends to be very chaotic. I guess the amazing thing about modern day markets is they're relatively unbalanced. In many respects, they're quite fragile. There is a lot of position clustering in similar themes. And the irony of 2021 is it could be the economic recovery itself that can take the wind out of risk markets, given that risk markets loved the crisis of 2020 once governments turned up and bridged all of those cash flow issues and put fiscal stimulus into economies. The recovery in and of itself could ironically have a mirror effect. So it's worth cautioning it will be via the bond market and those funding rates going up, which can cause chaos in through the corporate credit complex, and clearly that can jump across to equities at particular points in the cycle. It really matters the evolution of any kind of bond backup, and we know that that's very likely to continue in the very short term because of the way that the inflation profile will rise into that April or May period. Now, government bonds are a tremendously self-correcting asset class. They are a continuously compounding government-guaranteed asset, and they are completely unique in that regard. We will show you a chart that will show what happens after these periods of underperformance. You do tend to get very powerful performance shortly thereafter. So for those that are looking to build out their defensive allocations, maybe ahead of time, given that any kind of continued move can have vast implications for other risk markets, but clearly the timing is pretty ripe now into this window. And we'll certainly be writing about that a lot. We're going to be writing a white paper called Inflation Over the Hill, looking at that evolution of inflation coming through from the second quarter of 2020, when the world essentially stopped and we had negative oil prices. Now, inflation is a rate of change product. As we drop out that data in the year-on-year inflation numbers, we're loading in the second quarter of 2021, when the world essentially is open for business. And clearly there's going to be a lot of velocity to inflation in the very short term. We're also hearing lots about supply blockages because of shutdowns around the world. We think they'll actually clear fairly quickly once things start to open up, particularly in the Northern Hemisphere. But the irony of the bond sell-off here in the domestic market is that it comes at a time where our own data velocity has been rolling over. We've enjoyed the Great Gatsby comeback from particularly Melbourne, 25% of the country's GDP roaring out of lockdown into November and Christmas and through the holiday period. That's starting to slow down a little bit now. We know JobKeeper is rolling off at the end of March. We've seen already in Victoria the extension of emergency government power through to December. We've seen the way that politicians want to protect us all by locking us down. As winter approaches and we get to these much cooler climates in the southern states, you have to expect that just like everywhere else in the world this winter, we're going to have our own COVID problems. And so there can be a lot of stop-start throughout the balance of 2021, sadly. It is injection versus infection, and we are a little behind on our vaccine inoculation programs. Whilst we are behind, everybody will probably get locked down as a result. So we still foresee a bumpy road going forward. We know the data coming in will be incredibly volatile. This stop, start, stop economy, lockdown, open that we're seeing. Auckland have already had 2 lockdowns in the month, just gone. It's going to continue, so it can be quite bouncy. But I guess the overarching message of this video is to think about what are the broader asset implications if this volatility does start to jump asset classes. It's certainly something to bear in mind. We've seen multiple episodes of where this can become very problematic for markets, and it does garner, or it has garnered, additional policy responses from central bankers. Now, we know central bankers threw the kitchen sink at the problem in March 2020, and they would like to see things normalised to some degree, as they are. Clearly, economies are picking up, the virus has peaked in the Northern Hemisphere and the like. But there is a point at which, if the markets show them what's behind the curtain without constant central bank sustenance, they're not going to like what they see. And they've seen those episodes before and reacted very quickly. Whether that means an Operation Twist, where the Federal Reserve would sell short-dated bonds and buy long-dated bonds, that would be something that would calm markets, a tremendous amount. it almost certainly means additional RBA from quantitative easing from the RBA. The RBA are a long way from achieving their policy objectives with quantitative easing, which were to lower Australian interest rates versus other nations, primarily the US, and to drive the currency lower. Both of those things have moved against them since they announced the program. It's been our estimation that they will need substantially more QE than they've delivered thus far, and you can expect them to continue to extend. As I said earlier in the video, since the GFC, it has not been wise to fight the central banks. They do have an unlimited capacity to continue to operate, and the market is forcing their hand to drive additional operation into the markets. Otherwise, markets can become somewhat chaotic. It started in risk-free interest rates, but it will not end there. So think that through. Think through the policy evolution and the build-up of your own portfolios to make sure that the risk calibration is correct and you have the liquidity that you might need should there be another opportunity to get deeply discounted growth assets. Another thing that we're touched on just at the end of this video, it's a very long one, there will be some charts. We've got a lot of information that we want to share with you, so please do get in contact. Just recently we're hearing about Biden's plan for tax hikes after the passing of this $1.9 trillion COVID stimulus relief bill. Now, clearly that has vast implication for corporate America and can be relatively contractionary on a go-forward basis. Remember that nothing is as permanent as a temporary policy. And these stimulus programs, whilst wonderful in the near term, a big shot in the arm for an economy that's already recovering, leave a massive fiscal hole thereafter. So it's great in the near term, but it leaves us with problems later on. I guess Australia is dealing with that right now as the private sector is asked to stand forward as the government is standing backwards. And we're seeing those JobKeeper and that huge fiscal spend, which we enjoyed here, starting to roll off. That needs to be a smooth transition, otherwise economies are going to cool. So lots to think about in February. We do caution against all market movement. It's going to be a relatively volatile year. Once you have these episodes of volatility, markets do tend to stay more volatile for a time. So when, looking at the back part of last year where everything was relatively calm, risk assets were cruising higher, we've got to expect that that volatility will come to pass, and we certainly expect that it will skip into all asset classes fairly shortly, given what's happened in the bond market over February. Thank you very much.